Joining us, Koen De Leus is the chief economist at BNP Paribas and author of The New World Economy, a co-authorship on 5 trends investing in times of superinflation, hyperinnovation, and climate transition. Koen, thanks for joining us here on the Schwab Network. Appreciate your time.
Thank you for having me.
Hey, I see you guys got your book back there. Let's start maybe with the hyperinnovation side, because it seems we're back to relying on some of our big AI winners. Is that a major theme in your guys' discussion?
Yeah, certainly. So you have these 5 themes, these 5 trends, and I think the most positive trend, of course, is innovation. If you have innovation, then you can solve the huge amount of debt that governments have. If you have innovation, then climate transition is going to work, because you need a lot of more wizards, much more than doomsayers. If you have a lot of innovation, then I think, if you look to aging is not such a challenge neither. So I think innovation is the key for welfare, has been the key for welfare for over, let's say from the 1800 on. And now, we see that innovation productivity has come down enormously over the last 20, 30 years. But you see with artificial intelligence, you see with 3D, which is more accessible now, with renewable energy, I think, and my co-author, strategist of BNP Paribas as well, Philip Gessels, we think that we're in for an era of much higher productivity. It will take time. It will be in the next 5 years, but probably in the next 10 years, we're looking for a productivity that might be 1 percentage points each year higher than it is today, which is, of course, huge.
One of the main conclusions from an investing perspective so far, at least in the U.S. Market, has been basically index investing is just a kind of proven out way to capitalize on these companies gobbling up competition. I mean, basically one of the main ramifications of this AI innovation, it seems like, is a highly concentrated market, a few companies that are disrupting in a massive way that benefits the index, but also kind of de-diversifies our portfolios in some ways. So is that a good thing or bad thing?
Well, you put it very correctly. If you weren't in this magnificent 7, in these 7 big tech stocks, then you would have the market would have outperformed you. So you need to be in these stocks, in these Nvidia, in Google, in Alphabet, and in Microsoft. But it is strange as well. It's pretty strange, and it's pretty risky to only bet on these stocks, because what we've seen over the past decades is that every time that you have a hype, every time that you have a new wave of innovation, whether it be oil, whether it be chemicals, whether it be internet, it's all the time other stocks that are going to take over. And now it would be the first time that we see that this artificial intelligence hype is going to be led by the same stocks that have led the previous hype, which is internet. And so this is a little bit strange. From the other side, we have to see and we have to face the truth. If you are not in these stocks, you really are way behind in your stock performance. So is this a good thing? I don't think so. I think you have diversified out of these 7 as well. But the key for the moment, and it's maybe not a very courageous position that we take, is that we still have these 7 big part in our portfolio as well, because we know if they continue to increase like they increased over the past couple of years, then you lose out as an investment manager, and that's certainly something that we don't want neither.
Koen, the challenge for many investors over the last couple of years, of course, has been dealing with inflation, but now our rate of inflation has slowed somewhat dramatically. We're still positive numbers, generally speaking, but how does one kind of think about these major themes on a long-term basis if we are still kind of in this period of uniquely high inflation? Do you have to have a strong view on whether or not this current moment of inflation is going to end the way the Fed wants, down below 2%? Because over the last 2 years, there were a lot of, even books that I think about that kind of took a more negative side about this. The 5 major themes. I think about like Rubini's 10 major themes, right? A lot of them have sticky inflation as a major component of it. Does that look to be less of the case these days, or how does that factor into your assessment?
I think everything is a cycle, of course, but you have to look to the structural trend as well. And if we look to the structural trend in long term, then you come from 40 years of disinflation. 40 years where you see that you've gone from the great moderation, lower inflation, lower interest rates, and much longer cycles, economic cycles, because every time there was a slowdown, well, the Federal Reserve just pull down interest rates. Why? Because there wasn't any inflation. And I think that we're going now, because of these 4 trends, we're going now to a structurally higher inflation. So yes, indeed, I think the coming months, the coming quarters, you will see inflation coming down. But then, because of these trends, because of aging, you will see that the wage rises, average wage rises, in the developed world, and certainly in Europe, is going to increase faster than it has done over the past 40 years. You will see as well, if we look, for example, to deglobalization, globalization has inflation made come down, certainly inflation in goods. Well, you see deglobalization, and certainly if Trump is going to be elected as a president, although Harris is as well protectionist, this means that import prices, certainly in the United States, are going to go up. This is going to induce inflation. The same goes for climate change. Climate change, there are going to be quite a lot of catastrophes. And so to diversify your supply chain means that you need more suppliers. It means as well that you are going to make more costs, which means that prices are going to go up. That is a third theme of having higher inflation in the future. And then the last point is these huge amounts of debt, as well in the United States, where you see debts of more than 130% of GDP. How do you control this debt? By having a little bit of inflation, because if you have a little bit of inflation, debt is going to be much more more supportable than if you don't have any inflation. So everything is pointing to structurally more inflation, but from a cyclical point of view, you see that inflation is going to go down a little bit more in the next couple of months, the next couple of quarters.
Okay, so it comes down a little bit and then sticks around. Koen, real fast. We've only got about 30 seconds. And it may be a hard question to answer 30 seconds. Does the AI productivity not reduce any of those inflationary pressures a bit?
It's going to, but I think artificial intelligence, before it's going to increase productivity, we are going to be 5-10 years further. Okay. And then at that point in time, it will compensate part of this inflationary trend.
Great stuff. Really like it. Fun chat. Glad we got you. Thanks for your time.